CII Startup Bus session on the topic of startup valuation demystified: art, science, or sheer conviction. We have with us, and we are delighted to have with us, Ishang Shah, a chartered accountant and a CFA from USA and a registered valuer. He's a partner at Bansi Jain and Associates, leading the startups, transactions, and funds practice. Extensive experience in venture capital, valuations, corporate finance, and has advised various VC firms and startups. He's worked with over 500 startups and contributed to Shark Tank India as well. His practice comprises of due diligence, valuations, tax, ESOPs, AISF setups, and more at this very young age. I have had the privilege of moderating, I think, a couple of sessions with Ishan before. The topic remains the same, it just gets more and more interesting. Valuation is a topic of a lot of discussion, and Ishan today, there's not a single conversation I had where person does not speak about valuation, whether it's a polite social conversation with startups, VCs, colleagues, uh, everywhere. This is a hot favorite topic, and we have the hot favorite person to speak about it. I have requested Ishan to speak for around 25 to 30 minutes. If you have any questions, just do not wait till the session gets over. Post it. I'll be checking the questions, and we're going to stop at 6 p.m. sharp. So if you want to have any questions, just post it. As soon as Ishan finishes around 5:30 latest, I'll take all the questions. So over to you, Ishan, and thank you again for sharing your thoughts on this fascinating topic. Over to you.
Thank you, Ninad. And each time with Ninad's seniority that I have a session with him, interact with him, he only keeps getting younger. So Ninad is working with startups, and his time is becoming off startups, I would say. Right. To everybody, good evening. Thank you, CII, for putting together this program and the opportunity to speak to your audience on startups, valuations, and particularly now that we are in 2025, right? A time different from 2021, 22 for sure. That happened to be the best cycle, or you could call it the boom cycle almost now that we look at it retrospectively, where A, in terms of investments, B, in terms of companies, and C, in terms of valuations, everything was at its all-time high. From then to today, a lot of moderation in valuations, a lot of moderation in portfolios and companies, and ultimately a lot of moderations in startups, right? To come to where we should have always been. That's been our position. We always believe that there were a couple of outliers in the past, and where we are right now is where we would have been, and we are better than before, for sure. So with that context, allow me to just share my screen. The idea over next 30 minutes, as Ninad explained, was to maybe share a few ways in which you could approach valuation for your startups. I'm given to understand a lot of our audiences, companies which are just started out, founders, entrepreneurs, professionals, and maybe even institutions or education institutions that may be promoting a lot of them. Some of you may be incubators, accelerators. There are already 875 of you here in the Indian ecosystem. And therefore, I'll try and keep this to something that is relatable for largely early companies to raise in terms of keeping in mind when they're raising capital. So we're third largest, just short of US and China. US at number one and China at number two. 151 billion over the last 10 years. The number of unicorns at 118. Coincidentally, the number of unicorns, which if you have heard the term, are companies that are going to become unicorns, are also 118. So they're tied right now with Inc.42's latest publication. And 1,63,000 plus startups registered with the DPIIT. This is public information available on the website. And I call this the good morning and good night indicator because this changes every day. And if you get up the next day, you'll find this number higher than earlier, and then the day thereafter and the day thereafter, right? So this number is a homepage for us, at least in practice, where we know the number of companies are only increasing day after day. In terms of number of amount of quantum or investment quantums raised, 2024 was almost 12 billion. This is an indicative incremental indicator. It's just adding year after year. So it's always been an upward trajectory, while the quantum in each year may have increased or decreased to some extent. About 1,000 startups this year that have got invested. A lot of startup IPOs came in 2024. It was a great year for capital markets. Almost 13 plus companies: Swiggy, First Try, Go Digit, Ixigo, Ola Electric, Unicommerce, to just name a few, all of whom got listed, and more. Sorry, more in the pipeline for 24, for 25, 26, 27. Companies have a visibility of 2 to 3 years to go IPO. So they're all sort of planning for it. As we start this session, a first question to all of you all participating would be, what would be a startup? And one key or request and takeaway that I would have with each of you is to register with the DPIIT as a startup under the Startup India program. There are numerous benefits for you: legal, tax, a lot of government schemes. So if you're a private limited company, an LLP, or a partnership firm that's not older than 10 years or that has not exceeded 100 crores in revenue, and you're doing anything that is innovative, creating some improvement in any product, process, or service, or you're scalable and you tend to generate employment and wealth, you are completely eligible to register under Startup India on the website, the DPIT website of startupindia.gov.in. And it's free of cost. There is no government cost associated with this particular registration. Completely online. Should be 2 weeks, maximum third week, by which you would have that certificate of registration in your inbox. So if you don't happen to have one, I would make a sincere request post this webinar to get that going as the first step. It'll also help in any sort of fundraise, valuations, or anything else as well. There is no negatives associated with that particular registration. But if you happen to be a company that's not eligible, so if you're a subsidiary, if you're a joint venture, if you intend to have foreign companies, or if your entities which are formed due to merger or some sort of amalgamation, etc., then you would not be entitled to sort of register as a startup. So just make sure that your criteria are fulfilled. So now coming to the reason why we are here today evening, which is to getting to how do we value our young growing enterprise, right? Characteristics of young growing enterprises: no record of any sort of financial record, to be more specific, of any revenue, profitability, cash flows, or any other financial metric that would be suitable to track a enterprise. Those typically don't exist for startups. These are usually 1 year, 2 year, max 3 year old companies who are trying to figure out. Some of them are pre-revenue, some of them are product market fit, some of them have found out these two, gone to market, exploring the market, acquiring customers, and still sort of identifying what is their overall presence in the market and how they could become more sustainable or viable in time to come, right? So these are challenges to how we look at these companies, different, very different from a company that has maybe a 5 year, 7 year, 10 year financial track record, has a management, has a promoter management, has extensive teams for various business functions which have evolved over that 7-10 year period, have P&Ls which are sort of verifiable and traceable and historically mappable. So they are different bucket. They tend to get valued differently. There are finer approaches to valuing them, published ways to value them. There are capital markets, which are our stock exchanges where they publicly trade, and therefore best discovery of their fair value is achieved there. But these are private companies, very early and different from that set. So in terms of methods, obviously, technically, there is first common method that we follow, the dilution versus capital raise that you see as a green color. Then it's followed by a discounted cash flow method, a comparable company, a comparable transaction method, venture capital method, and a first Chicago method, right? So these are some of the methods which are sort of used. But I will focus primarily and spend more time on the first, second, and third ones, which we believe largely will be able to take you to a range at which you could look at valuing your enterprise at an early stage. There can't be a fixed number. We always feel that this will get negotiated as you sit across with an investor and discover what is the value of your enterprise. But yeah, it gives you that range where you can have a conversation. So dilution versus capital raise, the first one brings us to what we call the chocolate cake valuation analogy, right? What you see here is maybe in the circle or in the pie is your startup. This is a small entity to begin with, a Series A round and a Series B round where the enterprise continues to grow. Dilution is a word that indicates the equity reduction of ownership in the company. It is not the reduction of what you own. It is a reduction of the percentage of what you own in the company. As a founder, you will own, for example, in an Indian private limited company setup, 10,000 shares of a company, and you will always be the owner of these shares unless you sell your shares. But the percentage that you own is what keeps changing each time, which is what we call dilution. And fundraise is obviously the capital that is being raised. At an early stage, what is being evaluated is how much capital can be given to that company. And the founder is evaluating how much dilution can they do. This is how much equity they can part with. Now, all of you are already familiar with, I call modern television, where a lot of the negotiation happens on TV shows now. You're familiar with how investors would ask for capital in exchange. The founders are looking for giving up some ownership of the company. So mathematically, if, for example, you're looking to get 1 crore for a 10% stake, the total value is 10 crore. Now, at an early stage, between 1 to 5 crore would be the right amount of capital to seek. If you're absolutely early, maybe a founder that's just moved out or just started, and for an investor to take a bet or risk in your business. So 1 to 5 crore typically is our sweet spot. And as founders, they would prefer diluting anywhere between 10 to 25%, right? Some upwards of 30% happens to be a very high ask at the first stage, at the initial stage, and something that the founders may not be willing to part with. The founders also have a vision that if they end up giving 30% equity today, tomorrow somebody might also be looking to get equity in the company, which will be of that higher value because they have seen something in the past, and therefore again they need to dilute further, and that leaves the founder with very little equity in the company. So while the value lies in the equity, the objective is to get the maximum amount of capital possible and for the investors to get the best amount of equity, something that can make both happy and a deal go through. For example, we have done here 1 crore at a 10% stake makes the value 10 crore. 10 crore value is broken up into what we call post money and pre money. For again, arithmetical ease, 1 crore by 10% is 10 crore. So that 10 crore is after the 1 crore is invested. So it's called post money. And pre money is 10 minus 1, which is 9 crore. Now, as the company progresses, you will do another round. Let's assume you have a 15% investor interested, who's willing to put in 3 crore. So the post money valuation is 3 by 15, which is 20 crore. And as a founder, you've now given up 15% of what you own. The angel investor has also given up 15% of what they own. So that's the Series A round, where the value of the enterprise has now become 20 crore. And then you look at Series B, where assume a 20 crore, a 30 crore raise at a 20% dilution for a value of 150 crore. And ultimately the ownership percentages for each investor in the company reduces. Remember, the percentage reduces the number of shares that I own as a shareholder or as an investor or as a founder, they continue to be the same. So what does the investor gain here? The investor obviously gains their investment, for example, of 1 crore in the first round, which was at 10%, is at 6.8%. You see that in Series B, but of a 150 crore enterprise, that's valued at 10 crore. So one has become 10, which is 10x, the X that happens in startups, right? So that's where the multiple or the multiplier comes from. Founder's happy. The founder is roughly at 61% stake at a 150 crore enterprise, which is roughly 90 crore. So the founder's value is also linked ultimately to the value of the company that the founder is running, and therefore the desire to keep maximum equity possible. There is a sort of thought process with founders also, which involves around not just raising capital early from one investor, but a set of investors who are interested, right? So you can call this stitching of a round, where as a founder, you approach a few investors and see if the total amount of 5 crore, for example, that you wish to raise can be invested by a combination of 2 to 3 investors. So one could do 2 crore, the other could do 1, and maybe 2 others could do 50 lakhs each. So all eggs are not in one basket. You have an interaction of working with more than one set of investors, sort of broadens your reach, and in a way you get the capital that you want, because it may not be possible for that one investor to put in the entire 5 crore bet on you upfront. So you get the capital, but with a set of investors, and the economic objectives continue to be achieved. So that is on the entire sort of thought process to raise capital via trying to negotiate the equity you want to keep and the fund you want to raise. At this stage, you typically have also already diluted for advisors or mentors. So you sort of budget some equity if you are looking to get such people. ESOP, which is employee stock option plan, and that you see as a alphabet or a word next to founders. These work together. These are employees you would hire or propose to hire in the company and give them equity. So you keep some portion of your ownership also earmarked for such talent to be identified. So founder is also parting away with some equity on the ESOP side, some with advisors, mentors, and then the balance with the investor. This entire dilution is desired at 15 to 20 percent, so that the founder is able to keep somewhere between 80 to 85% in the company to begin with, and then follow on to dilute as the company raises more capital. So that's the first method. Most of our startups have pursued this approach towards early stage valuation. There isn't a sort of rocket science beyond this at an early stage, because we don't have financial matrices to track or follow, or for that matter, and use some multiples like an EBITDA multiple or a sales multiple in that sense. And hence, the desire is to get the capital, get running, and dilute equity. The capital is typically visioned for a period of 18 months to 24 months. You should be able to try and spend that money over that 18 to 24-month period. So that's the first way we could approach. The second one, I would like to take up the comparable transactions and then go back to DCF. So the comparable transactions approach, or a comparable market approach, is to find peer companies. Today, if anybody shares with you or tells you that my startup is unique, we commonly come back and say, no, it's not unique. Ideas in India are many. Execution is very little. And therefore, companies that can replicate your business will also come in. And plus, your business may be somewhere an extension of businesses that already exist, though you may be doing some niche or something slightly different from an existing player. So comparable companies are something that we secondly can be used. Your peers can be identified. They may not be exactly what you're doing, but close to what you're doing. They may have raised capital. They may have gone through fundraising cycles. They may have maybe bought back ESOPs, for example, in their companies. They may be listed They may be listed not in India, but in another geography. They may have been raising capital in another geography. Could be US, could be Europe, could be the Middle East, could be China. And there are public databases available from where this information can be extracted. Therefore, the next benchmark is to compare the value of our young company with the value of another enterprise. There too, the objective is to sort of look at it two ways: at what value and what dilution did they raise their original round. Not necessarily a metric, just their journey of how much they raised and at what dilution in their first round, second round, and third round. Right? Not necessarily to compare matrices, because these matrices may not be publicly available. User data, or the average downloads, apps, and the average revenue per user, etc. These matrices do not pretty much exist in a public domain. But what they have raised and what valuation they have raised and how much they've diluted are typically publicly available. So that's the second way to sort of approach trying to find peer companies and identify or discover value basis what they are last valued at. The third is a discounted cash flow approach. This is something that was recently followed by a lot of professionals till the tax law abolished what is called the angel tax in the past, right? So the budget in July 2024, anyway, happy announcement. And we had a lot of happy Nirmala Sitharaman memes going around in the startup ecosystem where startups were very happy. The entire concept of angel tax was fully deleted from the tax law. The law was to value startups and do a method to value them, which was the discounted cash flow method. This law no longer exists. So as a freedom of choice for startups, you can raise at any value, any capital from your investor. Nobody is there to question you this anymore. There was a tax regulation that sort of had questions around it. This regulation is now finished. With that, you have a bilateral process with your investor, discover value, and go ahead with it. In terms of just, however, academically pursuing a valuation, the discounted cash flow method would do a projection of your business revenues, expenses, working capital over a period of 5 years and maybe a terminal year beyond that, and then bring that to present value. So it's a scientific method that forecasts the business and brings it down to its present value in order to sort of discover what is the present value of these cash flows of an enterprise. Right? So that's on the comparable company and the comparable transactions method. The comparable companies similar to comparable transactions. So in case of transactions, you try and pick up fundraising instances in peer companies. In case of comparable company, you try and compare it with the company itself. So that's the two differences between comparing a company and comparing a transaction, both of which can be publicly available information, both nationally as well as internationally. The venture capital method is a reverse calculation based on what VCs typically expect returns in investments that they do. So the VC industry typically has a 25% IRR over a 8-9 year fund life cycle, right? Which translates to a 3x or a larger sort of return on the capital that they have totally invested across companies. So if a fund was set up with a 500 crore asset under management, they would think to achieve at least 1,500 crore from their portfolio of investments, and therefore they would try and value the enterprise, thinking that if they were to receive 3x after a certain period of time, how much do they need to own today when they are investing in this business, and how much do they need to invest. So it's a mathematical calculation to say this is desired return that's discounted to present, and how much do we invest and how much do we own in the company, sorry, so that we can earn the desired return. In terms of, so that's I would take a maybe 30 seconds pause here to just summarize in a more shorter manner how you could approach some ways in which you could go about and start finding information on how to value your enterprise. Peer companies you can find on public databases like Traxen, Inc42, VC Circle. There are some expensive ones in the form of Bloomberg and Capital IQ. So those are all public platforms. Some of them are paid, some of them are pay per use, some of them have limited free use information, but they track the entire set of companies on the entire web, which is not just India but globally, in sectors and within sectors, in stages within stages, across different stages. So that's if you're looking for an avenue on where you could get some of this information, then these are places where that can be found. In terms of instruments or what happens from an Indian context, when you raise capital is through largely equity shares, CCPS, which is compulsory convertible preference shares, debentures, convertible notes, and venture debt. So those are options that you could pursue in order to the instruments that you could pursue in order to raise money. From an India context, that is how it works. Also, can you raise money? A common question in a LLP or in a private limited or in a partnership firm. So what if my startup is a LLP? Can I raise money? Is a common question, to which the answer is pretty much no, because the private limited sort of structure has a share capital base, has shares. You typically value shares and give shares. In an LLP, you only have a partnership interest. It is difficult to sort of value a partnership interest versus value a share. And the partnership interest is also not something that can get liquidated or listed uh, easily or be sold such that you sort of earn a capital gain on what you sell. So it is under a share structure that these type of instruments, or a private limited company structure, that these type of instruments and the fundraising journey can happen. With that said, should every startup be valued? Should every startup raise money? The answer is no. We have some fabulous examples in Zerodha, uh, in uh, in Zoho Books or Zoho in general, as companies that have raised zero capital, absolutely zero capital, but they are sizable, valuable, and they've been in business for decades by now. So it is not necessary that fundraising will help determine value. Your company can be bootstrapped from day one. Bootstrapped is a word, again, a terminology for a company that has not raised capital ever. So we call them bootstrapped companies. So companies that have not raised capital ever, and they have continued to grow basis their own internal accruals of capital or their internal business doing well, them being profitable and reinvesting the profits in their business. So that's also another view on companies and valuations, which is there is no need that there needs to be money raised for value to be determined. Can you get access to domestic capital, foreign capital? Absolutely, yes. Startups can raise money from foreign investors. There is a regulation called FEMA, the Foreign Exchange Management Act, that allows you to take capital in your business. There are certain negative lists, but we can look at them in a more greater detail when you want to do that. But yeah, there is no restriction on your company. If you have your friends and family who are NRIs, please do reach out to them and let them know you're starting up here in India, and you're free to take their capital. So that way, your limits are not just destined to Indian investors, you are open to global investors as well. There's a company law and there's a tax law that you sort of need to take due care of when you are raising capital either from domestic or from foreign investors. With that said, I wanted to leave us with two examples or three examples of companies that where you would have seen this entire journey span out, right? There is this concept of series funding, which is A, B, C, D, E, F, G, H, I, J, K, and here's something that basically makes sure that you know your alphabets very well. But a company like Ola that has raised 17 rounds of capital, right, raised totally 15,000 crores and the last valued at 42,000 crores. So founders ownership obviously now over time, as you saw in the first image, keeps reducing. the value of the enterprise keeps growing, and that is how journeys have gone through. Rene, which is another company in the cosmetics space, because consumer facing companies in India have picked up. In 2024, fintech, consumer, and SaaS deep tech happen to be the most favored sectors in terms of capital raise. 2000 plus active investors who are investing in Indian enterprises, and almost about 1,500 AIFs now with SEBI, which are alternate investment funds that are investing in startups. So that the entire base has widened over the last 4 to 5 years. And the purpose of showing Rene as a company was also that this is still a company that is active in the market. It's not something that's gone out of the way. It started its journey about 3 years back, where founders who were founders of another company called Beardo, and you will maybe recollect this name, they sold a business and they started a new one. So again, the reason to show is that the journey doesn't stop; it only starts all over again. And so they sold their first company to start another company. Obviously, here they have about 50% ownership still in the company, last valued at 137 odd million. And they've also managed to raise 50 million, which is roughly 400 odd crores over the period they have been in business. And the third is our poster company today that you find on the stock exchanges, which is Zomato, and there the entire journey till an IPO, right? So that's the full circle, the IPO circle, right from their first round at and whenever and whatever that value was, which is roughly 1.6 million, to an IPO, which was last at 7.2 billion. Hope to see you all here on this list. This is the list of companies of Sunicorns, unicorns, and then there are those above 5 billion or even larger. So maybe larger value enterprise. But if some of you or all of you make it here, it'll just be more proud. We wish to have 4 more slides of just these companies. But yeah, just to share from a context of where we're coming from, these slides or these pages did not exist. The Economic Times didn't have a page for startups 4 years back, 4 to 5 years back. Now they have 3 pages only for startups, the first page and then the third and then the fourth. We didn't have media dedicated around growing companies. Now we have quite a few of them. And this is only set to grow further with us looking to become number 2 and number 1 ultimately in entrepreneurship and companies that pursue. There is enough opportunity across sectors. Yep. Thank you, because we wanted to leave a lot of time to interact with all of you, and hope this short presentation has been helpful.
Thank you, Ishank. I think you set the context very well. There are already a few questions, but viewers, if you have any question, just post it. I'm going to take it up as and when they come. I have some questions, but I will give preference and priority to people who have asked questions. So there is a question on how do you avoid pitfall of overvaluation, especially during fundraising?
Right. So how do you avoid the pitfall of overvaluations? What I understand.
That's right. That's it.
Okay. Okay. So it's been a frenzy where obviously the valuations got sort of out of leaps, right? They were very high in value. There are actually companies that experienced down round, by the way, in 2024. The best way to sort of do this is to manage the dilution and the fundraise, like I said, in the rightful combination, right? Don't be over aggressive in the valuation asks just because you want to dilute very little. Give up equity that needs to be commensurate with the amount of capital raised. That's number one. Number two, the multiples, if you're using them, use reasonable multiples. If there are companies that have raised money in 2021, 2022, with due respect, don't consider those as benchmarks, because they were times where the valuations were out of hand. So sort of your comparable companies and comparable matrices can be something that is post that period or pre that period, and those multiples are need to be reasonable multiples. So there are concepts around industry averages that you can also use. So there is an average, not just a number, but an average. And if you stick to an average revenue multiple or an average profit multiple or an average earnings multiple, you're most likely to be in the right spot and not be overvalued. And in the first case, not to give up too little equity or to raise too much money by giving up too little equity, both of which again sort of make you overvalued, right? So these are two ways I think you can at your end take a precaution. But that said, as entrepreneurs, the job is to find the best value. Okay. So if at all there is the thought that this is overvalued, I think you will be your best judge. But otherwise, if you're getting value, there's no founder that says, no, I'll take a lower value than whatever is being offered. Okay. So that's likely not to happen. Uh, find the best value and make sure you do better than that.
Okay, great. There's a question from Sai Khanulkar who says, how do economic downturns affect startup valuations? And what should founders keep in mind during such times?
Okay.
Interesting question.
Yes. Definitely, economic downturns do impact startup valuations. They impact valuations because it's a downturn. So the fact is, what has happened before this has been the anomaly, and hence what is happening now, like I said at the beginning, is what was most likely to happen. So there will be lower valuations when this happens. There will be a stretch for capital. Not everybody is willing to invest in private companies. Their investments are very illiquid. Sorry, you don't get to exit easily in startups. You need to find a buyer for your shares to exit, or you need to IPO, which is a very different and long journey. For companies that plan to IPO, they need to prepare for IPOs. They need to have internal control system on financials, on reportings, on their entire organization to be preparing for an IPO. Companies typically prepare 2 to 3 years prior to going for an IPO. With startups, it is difficult to find liquidity. It is based on being able to find a buyer, and therefore your valuation, capital, etc., are all at stretch. How to tide over this? Make the business independently sustainable. A business should not sustain basis fundraise. Try and avoid that in your business. If your business can only grow if it can raise capital, you're most likely to suffer when capital is not going to be available, which is when the economic downturn will happen. So if you want to withstand the downturn, grow the business without being dependent on capital. It can be an add-on, it can be the injection, it can be the booster, but it can't be what determines whether you will grow or not. If this is taken care of, and if there is profitability, or let's say you're not completely profitable, we're still good with that situation, but you can't be dependent on growth or sustaining just basis capital, which will sink when the economic situation changes. I think these two things to take care of, so that you can tide over a difficult time.
Ishang, if you're done with the presentation, you could stop sharing so
Okay.
we'll come on full screen mode.
Sorry.
No problem. So, participants, viewers, just post your question. There are some simple questions. One is, you had said about comparable companies' data. One question is, from where do you get this data?
Yes, I was just sharing. So Traxin, VC Circle, Venture Intelligence, the more easier or accessible ones I would say, and something that are India grown and focused. Traction is even a listed company. In terms of global, you could look at Bloomberg, you could look at Capital IQ, but they are sort of paid databases, typically quite expensive. But these are public platforms or sort of websites where you can get comparable company information.
So you have kind of responded to this in presentation, but since there's a question, you could quickly reiterate. Vidya Joshi, Nutrimillets, is asking, we are a privately held company in the millet business recognized by DPIT and founded by a woman. Currently, we're in the early stages of generating revenue. So it's almost pre-revenue, early revenues. Advise us on how we should approach valuation.
She would also want to know whom to approach. On
Yeah.
how, I think we've sort of cleared, but I can give her guidance on whom to approach. That will help her start a conversation. So Vidya, what you could do is a few places that you could approach. First are angel networks, angel funds, or angel investors. These have now consolidated as angel funds largely, with SEBI allowing angel investing in a more regulated manner. So you could go to angel funds. Second, you could go to venture capital funds that typically invest pre-revenue to early revenue stages. And there are quite a few throughout India. Ninad heads one, right? They've been funding hundreds of startups. Ninad, if I could be correct in sharing that. And therefore, you have one gentleman ready here for you to approach. That's the second sort of set you could approach. Third, family offices. They have come in quite active, Vidya, and the family office is largely uh, maybe a successful entrepreneur or a well-established entrepreneur or a wealthy family who are interested in investing in startups, promoting companies. Sometimes these companies are very close to their family businesses, and therefore they're able to integrate well, strategize well, work with you well. So third avenue is family offices. I think these three you could begin with to sort of start having conversations on raising capital.
So Vishal Sangvi has asked a question. Let me try and rephrase it. So he's saying, does valuation depend on stage of proof of concept, market acceptance, innovation? How are all these factors, how do they impact valuation? Because obviously he's looking at more capital for bulk. But let's say proof of concept, market acceptance, innovation, each of these factors combination, how does it impact valuation?
Yes, Vishal. So, hmm, I would say the earlier, so I understand these are actually three buckets to a very early journey. The proof of concept, the market acceptability, and ultimately the go-to market, right? And when we do fundraising, we say something like pre-seed, seed, and then go to series rounds of capital, right? So we call this seed capital. Now at seed stage and at seed capital, your valuation will typically be single digit or very low double digits. And very low double digits mean uh, being below 20 crore, right? Here, you're still yet to prove whether your business can viably exist. Let's say we've passed one stage, which is the proof of concept is done, whether the market would accept your particular product. And the third, whether you will be able to scale what you have built. So pre-seed, seed, and series. That's the way we'll look at it. Uh, Single digit valuation to low double digits because you're not still revenue generating. You'll need some capital. You'll exchange equity for that capital, and that will help you value better. So you could go maybe 10, then you could go 20, maybe you could scale and then go direct 50 or direct 80. That also would be a good benchmark. But yeah, you'll have to begin very small since you're starting the capital raise journey very early, particularly when you don't even have a proof of concept or you've just had a proof of concept and then you're starting to get market validation and go to scale.
Thanks, Ishan. There are a lot of questions. So, Ishan, now I'll have to request you to be crisp in your responses because we're going to stop at 6 p.m. I have promised you. You've got some other meetings after that. So, here's an interesting question, right? Regulatory scrutiny or regulated, areas of startups, finance, tech. How does it impact valuation? Because, this regulations can be a dynamic factor.
So these are so startups in entities which are regulated, right? Where you have a presence of a regulator.
Correct, correct.
And does that impact valuations? Yes, absolutely. Because there, what other than all the risks that a business is usually open to, there is a risk of regulatory risk, or what we call a regulatory risk. You would have seen recent examples for Paytm. For example, a listed financial services company, startup, obviously one another company that has gone to do wonders in the ecosystem, being financially regulated and being punished in terms of its value on the stock exchanges due to any regulatory issues that arise. So regulations do play a very important role. They are largely driven by the entity being compliant to those regulations. So non-compliance doesn't become an option for those companies. If they become non-compliant, or if they are non-compliant, regulation is likely to take a hit. Nobody would want to invest in a company that is not compliant. You will not get investors easily if that baggage is carried upon in your business. The investors knowingly will take a risk that you are a regulated business, but they would invest in your business knowing this risk, but they would not take the risk of you being non-compliant. That is not the risk that they have budgeted for when they invested. They budgeted for the fact that you are a regulated entity. So with that context, regulations or any regulated industry can impact value if you are becoming non-compliant or not following the regulations in that industry.
Okay, thanks, Hisham. Sai Khanolkar is making good use of questions. I'll go to a second question. Very interesting. How do you see startup valuation with the rise of AI and new business models?
Oh, so AI is changing a lot. Deep tech happens to be the second largest sector now, almost, that is garnering capital. How is it going to change with AI and new business model? I think a lot of it will change. AI will become a part of businesses. They will have to be more efficient using this technology. I don't see any valuation change because of this reason, but there will be a new set of companies called AI companies that will come, and which are already coming. Uh, those businesses will see a lot of action, a lot of attention, and they will be able to influence other businesses or push businesses out of existence, right? That is likely to happen. We are already working with a couple of companies that were in businesses before AI came in, and now they're out of business with AI. Those businesses have shut down. So they could eat existing businesses, or they could be businesses themselves and attract capital.
So there are a couple of questions I'm trying to combine. How do you have value intangibles? One question is about R&D and defense. There's another question on copyrights, startups, and valuations. So let me bucket it all and say, uh, Ishank, what weightage do you give to all this in valuation?
So I would say these are bucketed under a head called intangible assets.
Correct.
We call them intangibles. In this, we believe there is only one intangible that is of good value or significant value early, which is patents. If you happen to have patents which are published or which are therefore accepted patents, and they typically have a lifespan, sometimes between 10 to 20 years, where nobody else can do what you are doing. This is a monopoly advantage and something that certainly is of value to your enterprise. There are methods to value patents in terms of discovering how much revenue the patent can generate, and therefore what should be the value today. That would be the way in which the patent gets valued, and the patent will be the valuable intangible. If you ask about trademarks, copyrights, anything else in terms of know-how, process knowledge, codes, we don't consider these really valuable too early, because it's not that your logo is something that people recognize or familiarize with at a large scale, or not something in terms of codes that nobody else can write if they see your outcome or output. So those have lesser value. Patents which are granted would be of most value, and there is ways in which we could monetize the patent and identify the value.
Sai Kanolkar has asked one more question. What challenges and opportunities startups face in valuation when attracting international investors?
Oh, Challenges and opportunities. Opportunities are far more than challenges, at least on the international audience. Sai and Ninad, you would also know the interest in the Indian diaspora outside, with obviously the government's initiatives and efforts has been phenomenally high. They're all keen to invest in Indian companies. The ecosystem is accepting foreign capital as we were just going through the presentation. There is no limit there. There are most sectors 100% FDI, which is FEMA approved sectors. So I think the opportunities are endless, no geographical restrictions except a couple of countries with which India shares land border with, and there is a rule that deals with that specifically. So you don't have any restrictions in terms of investors or in terms of quantum of capital, and there is enough interest. Challenge wise, they are outside India. They can give you capital at max. It's difficult for them to do beyond that. Initially in your business, they can help you expand to overseas geographies is number two. They are typically exposed to exchange rate risks. Again, something they know when they invest. But yeah, the risk is high, especially now with dollar at 85, 86, almost 87 versus what it was a year back and what it was 3 years back, right? So they are exposed to this full exchange rate risk. And that's pretty much the downside for them, along with a pure equity investment downside, which is that the investment cannot do well in future. Other than that, there are no challenges. The sectors need to be automatic FDI.
Let me ask you one or two quick questions. Can you help founders understand some nuances about convertibles? Whether it's a convertible debenture, convertible preference shares, and what are the points they should look at when they're offered a convertible in a valuation?
Okay. So always our discussion has been valued at. So here's a deviation. A convertible is an instrument that says not valued, right? It's an instrument that says that A and B, which is the investor and startup, cannot agree to a value. I feel it is X and the investor feels Y, and we do not find a middle point. But like always in startup world, you need to make things work. So here's the sort of option to do that. Convertibles are an instrument that allow you to take capital with no value discovery. So it's as simple as this. You will take in 5 crores and there is no percentage ownership identified. But obviously this can't continue. It is just pushing a situation of today into the future. The convertible will therefore convert into equity shares in future based on some formula that you and I can agree to today. So it can be some formula, some discount to whatever the value of the company will be in future, in a round of capital where the company has matured and where there is actually a value that is discoverable. So that is the way in a convertible works. It pushes value discovery to a future and based on a formula or a percentage mechanism of a future value, and it'll convert in future basis that. What do you need to take care of? You just need to take care of the fact that your discount percentages or the formula that you are assigning to conversion in future is something that's good enough and not something that is deeply discounting and ends up being at a value lesser than what you would have diluted today. That's the last you want to be at. That's the only thing to take care of. Otherwise, even foreign investors, by the way, can do convertibles in startups. It's not just restricted to India, and this benefit is allowed under FEMA only for startups and not for any other kind of investors or or any other kind of Indian companies. It's allowed only to startups.
Ishan, what about down rounds? What should a founder be careful about in valuation when there's down round?
So down rounds, while it's not desired, it is something that is happening and something that can happen. We believe there is no wrong. It's just a way to start and keep continuing from where we've last been at. In down rounds and under investment contracts, when you raise capital, there is a right called the anti-dilution right that comes in for an investor. So the right and the investors believe that when they invested in the company at X value, if the value is lesser in the future, then they have a right to get equity at the lower value, which is called the anti-dilution right. So this typically triggers in. It is customary to investment contracts and agreements. The founders need to take care of the fact that there such a right exists, and that if at all there is a down round, further equity gets issued to the investors, and it obviously dilutes the founder. So with that right being the only other item that causes a sort of problem for the founders, there's no other issue. But these are contractual rights, not something that you can negotiate away with, because the investors feel that they are entitled to invest at the lower valuation.
For secondary, is there anything specific you want to give as a guidance to startup founders if they have a secondary offer?
Okay, so secondaries as a word, again, to just introduce everybody to the jargon. Till now, all of it was capital raised by the company. The money comes into the company issues shares to the investor, and everything is between the company and the investor. Uh, all other shareholders or investors, they stand where they are. Secondary is different. Secondary is now a relationship between one investor or one shareholder and another shareholder. So if I am an existing investor of the company, I will sell my shares to somebody else who is interested to buy my shares. And that is what we call a secondary. Now, with that construct, this is typically also how exits happen in the ecosystem, where our shares are sold, and also happens in case of an IPO, where shares are offered of existing shareholders for the larger market to subscribe. Now, these secondaries, at least in private companies and part of investment rounds, can happen at a discount to what the fair value of the company is, right? Because in a fair value, the money is going into the company. But in case of a secondary, the money is exchanging hands. It is between A and B, from A's pocket to B's pocket. Typically happen at a discount, usually between 10 to 20%, sometimes 25% discount to the fair value of the enterprise. It is a individual decision to sell shares or not to sell shares. It is dependent on the shareholder. Founders also, as they need liquidity, while they're invested with the business, tender their shares for secondaries, and therefore it's sort of a one-to-one transaction and typically at a discount to fair value. But it can happen at fair value as well. There is no rule as such. It's just a demand supply situation.
We are just 3 minutes away, and I would like you to put some closing comments to our discussion. What are the emerging trends? What are the good things which are happening in the valuation space? Some people ask for your email ID. I'm not giving it, but if you're okay to give it, you can post it over there. They can obviously connect with you on LinkedIn and get from there. But give some summary comments on some emerging trends in valuation, and then let's close our discussion with some of my comments. So, what are the trends you are seeing as you stand today and things happening for times to come? What are the emerging trends?
So emerging trends, Ninad, they are coming around now: deep tech, climate tech, and SaaS, which SaaS being software as a service. I think these three sectors, followed obviously fintech and consumer, continue to still uh, occupy most of the attention. But climate tech, deep tech, comprising of AI, ML, because of AI's boom, and the SaaS companies are doing well. What we are seeing there is capital, while it has slowed on account of a lot of market activity and a lot of capital being taken back to the respective geographies. So US seeing a lot of investments happening within their country, and China also doing a lot of liquidity boost within their country, right? Local geographies are pushing their own sort of enterprises, and but if from an India context, the number of AIFs, which are today 1,500, they're increasing by almost 200 every year. They are the source of capital, or a large source of capital coming into the Indian ecosystem. Good founders, good businesses continue to get good value, uh, and and they don't find there's not too much of difficulty. in them raising capital. So I think that ways, no problem. The company is going to IPO in 2025, 2026. Startups, they're going to increase. They're all getting ready. And I think we'll see a lot more activity happening across the ecosystem in 2025, 2026. So that's the sort of roadmap. We've already done almost 150 plus billion in last 10 years. I think the vision is to now do that in half the time in the next 5 years.
Okay, Ishan, thank you so much. You have covered a broad range. You have given a masterclass in a sense on valuations. You're getting applause also. A lot of people have appreciated it. But I must say, I every time I interact with you, I also get educated, which is great. Founders, in a success of a startup, obviously business and execution from a VC perspective always is very important, but eventually, the concept of valuation, dilution, all that becomes fairly critical to the eventual success. India is a place where you're seeing a lot of startups, and what you have shared with us today is truly, truly beneficial to all the founders. So thank you on behalf of CII, thank you on behalf of our committee, and thank you on behalf of all the founders here for sharing your thoughts openly and all the methodologies. Founders will truly be benefit from this session. Viewers and whoever are seeing this, this will be on YouTube. So if you want to share it later, you'll get a link of this later. You can share it with your friends. Thank you, Ishan. Again, hope to see you again on this very evolving topic of valuation. Thank you. Thank you for demystifying it.
Thank you, Nina. Thank you, CII, and all the participants who've joined. Thank you for listening through. And yeah, we'll meet soon on for whatever is going to happen next on the ecosystem.
Thank you. Thank you.
Thank you.